Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know, first, France's €44 billion budget cuts trigger nationwide strikes, widening the France-Germany bond spread and threatening Eurozone stability. We'll explore how this social unrest over austerity complicates the ECB's inflation fight and tests the EU's new fiscal rules. Second, EU's €150 billion defence plan, funded by joint bonds, marks a major step in fiscal integration as the UK negotiates paid access. In this episode, we'll break down this major leap in EU fiscal integration and what it signals for investors and the future of the euro. Third, a feared $6.6 trillion deposit flight to crypto stablecoins sparks a Wall Street battle over the future of US banking. We'll analyse why this potential capital migration matters and how it could tighten credit conditions and challenge the traditional banking business model. France's new Prime Minister is facing a political firestorm just 1 week into the job, confronting the very crisis that brought down his last two predecessors. Nationwide strikes have erupted across the country, with unions expecting up to 800,000 people on the streets to protest budget cuts. In response, the government has deployed 80,000 police officers, and clashes have already been reported. The numbers behind the shutdown are staggering. Public transport in major cities is crippled. A third of all teachers have walked out. And in a jaw-dropping show of solidarity, an estimated 98% of the nation's pharmacies are closed. Sustained nationwide strikes act as a direct drag on the economy. These disruptions will almost certainly depress France's high-frequency activity data, things like the services PMI and retail footfall, which are key indicators of economic health. A domestic demand shock in the Eurozone's second largest economy could easily derail the bloc's fragile recovery. We should keep an eye on France's next GDP growth report, as these strikes pose a material downside risk. This all centres on a deeply unpopular proposal for €44 billion in cuts, a plan designed to tackle France's spiralling public debt. To put that figure in perspective, the national debt is now equivalent to almost €50,000 for every single French citizen. Actually, this isn't just a domestic issue. It has the full attention of international financial markets and the European Union. Investors are watching a key indicator called the France-Germany 10-year bond spread. Think of it as a fear gauge. A wider spread means investors are demanding higher interest to hold French debt compared to super safe German debt, signalling they see more risk in France. That spread has already widened by over 30% in the past year, showing that market nervousness is growing. Furthermore, this crisis puts France on a collision course with Brussels. The EU has recently reformed its fiscal rules, which generally require member countries to keep their budget deficits below 3% of GDP. France is at risk of breaching this limit. This situation is the first major test of the EU's new rules. If the European Commission triggers what is called an excessive deficit procedure, it could force France into even more austerity, sparking a crisis over the entire bloc's economic governance. But here's the core conflict. A major union leader has called on workers to be out in force to put an end to policies that only serve the richest. Meanwhile, the outgoing Interior Minister has issued a stark warning that he will be uncompromising and relentless, giving police instructions to make arrests at the slightest slip-up. Understanding the economic dilemma is crucial. If social pressure forces the government to abandon the cuts and increase spending instead, this stimulus could prove inflationary. This would complicate the European Central Bank's job of fighting inflation and could force it to keep interest rates higher for longer across the entire Eurozone. So while the cuts are painful, giving into the protest could create a different kind of economic pain for everyone. This is a high-stakes standoff with no easy answer. The new Prime Minister, Sébastien Lecornu, is leading a government with a hung parliament, facing a nation in revolt, all while staring down a financial crisis where any move to control the massive debt risks complete political collapse. And the pressure is already showing in capital flows as unions and left-wing parties push for policies like a wealth tax. There's evidence of preemptive capital flight. Recent data from the Banque de France showed a massive capital and financial account deficit of €15.3 billion in a single month. This is wild because it's the largest such outflow since 2006, suggesting that capital is already responding to the political uncertainty. So, what's next? In the near term, we should watch three things. First, that France-Germany bond spread. If it continues to widen, it means financial stress is increasing. Second, Keep an eye on high-frequency data like France's services PMI to see the real-time damage to the economy. And third, listen for any statements from the European Commission in Brussels about France's budget, as that will signal whether a larger EU-level confrontation is brewing. Speaking of European power plays, the European Union is about to unleash a €150 billion defence spending spree, and the UK is lining up to pay an entry fee just to get a piece of the action. Now, get this isn't just about buying weapons. This is where the situation takes a more complex turn for the European Union itself. The plan is to fund these loans through joint borrowing by the European Commission, meaning the EU as a whole will issue bonds on the financial markets. This is a massive step. By comparison, they did something similar with the COVID-19 recovery fund, but using joint debt for a core state function like defence is a profound advance in EU fiscal integration. It sets a precedent for using the EU's collective balance sheet for common goals, which could fundamentally change the financial landscape in Europe and the value of the euro. The EU's new Security Action for Europe, or SAFE scheme, is designed to flood the continent with loans for a massive rearmament effort, funding everything from ammunition and artillery to advanced missile defence systems. But that's not the whole picture. The real turning point is that as a non-member, the UK cannot apply for these loans. Instead, British ministers are now in urgent talks to buy their way in, allowing UK-based defence firms to bid on the lucrative contracts funded by the program. The British defence sector is a cornerstone of its high-tech manufacturing base, contributing about £12 billion to the economy and supporting over 164,000 jobs. Access to the SAFE program isn't just a bonus. For many firms, it could be a crucial lifeline post-Brexit. The negotiations are already getting tense. The EU is demanding an entry fee, and talks are centred on just how much British firms will be allowed to contribute. Right now, UK companies are capped at supplying just 35% of a project's total value, a limit the UK desperately wants to raise. Reports suggest France is keen to restrict how much non-EU companies can benefit from the EU-backed loans, creating a significant diplomatic hurdle. Interestingly enough, this isn't just about money. It's about a core strategic debate inside the EU. France's position is a key test of the bloc's strategic autonomy doctrine. We're seeing tension between two competing visions. One is building a self-reliant fortress Europe in defence, while at the same time, the other is fostering a broader, more efficient alliance that includes key partners like the UK. This negotiation will reveal which path the EU is leaning towards. This all boils down to a high-stakes game of leverage. The UK's Defence Secretary has stated the country is willing to pay its fair share, but in return, it wants a say in the programs and to retain its valuable intellectual property rights. With a deadline to join the first round of bids fast approaching at the end of November, the pressure is on. 19 EU countries have already applied for the funds, with Poland alone allocated a staggering €43.7 billion, followed by Romania and France. Here's where it gets interesting. The SAFE scheme is acting as a powerful fiscal accelerant for these frontline states. By using the EU's top-tier credit rating to borrow, countries like Poland can fund their rearmament far faster and more cheaply than they could on their own. Poland already has a mind-boggling $133 billion military modernisation plan running through 2035, and this EU money will pour gasoline on that fire, creating a concentrated boom for companies that make land systems and air defence. It's a stark reminder that in the new European security landscape, access comes at a price, and the UK is now deciding just how much it's willing to pay for a seat at the table. So what should we watch for next? The most immediate focal point is the outcome of the UK-EU talks before the end of November. The final decision on the contribution cap for UK firms will tell us whether this deal is a genuine economic opportunity or just a symbolic gesture. On the macroeconomic front, keep an eye on the yields of these new EU bonds. How the market prices this joint debt will be a major indicator of investor confidence in the EU's new, more integrated fiscal path. From European defence spending to American financial warfare, a US Treasury Committee just dropped a bombshell estimate. $6.6 trillion could be pulled from bank deposits and moved into crypto stablecoins. To put that number in perspective, the latest data from the Federal Reserve shows that total deposits in all US commercial banks are around $18.3 trillion. So we're talking about a potential shift of more than a third of all bank deposits. Such a massive capital migration would fundamentally alter the banking landscape. This potential colossal shift in capital is at the heart of a regulatory showdown brewing on Capitol Hill between big banks and the crypto industry. The trigger? Crypto exchanges like Coinbase and Kraken are offering rewards on stablecoins with yields as high as 5.5%, a direct challenge to traditional banks. Banking advocacy groups are firing back, warning lawmakers this will lead to a rush of customers yanking funds from community banks. In a letter to Congress, they argued this trend could effectively neuter the ability of banks to lend into the real economy, and they are pushing to prohibit these crypto rewards entirely. Banks take out deposits and lend them out to people buying homes or businesses expanding operations. This is a core function of the economy. If a huge chunk of those deposits disappears, especially from smaller community banks, their lending capacity shrinks. This is what economists call tightening credit conditions. It's like a form of monetary tightening happening outside of the Federal Reserve's direct control, potentially making loans harder to get for everyone. Coinbase CEO Brian Armstrong calls that argument a boogeyman. He claims the real reason for the pushback is banks trying to protect the $180 billion they make from their payment businesses. He says this is a fight funded by big banks, not small ones. The core business model for banks is built on something called the net interest margin. That's the simple difference between the interest they earn on loans and the interest they pay out on our deposits. High-yield stablecoins directly attack this model by forcing banks to either pay more for deposits, which squeezes their profits, or risk losing those deposits altogether. The battle is escalating from corporate boardrooms to the halls of Congress. Both sides have sent letters to lawmakers attempting to sway a critical market structure bill. While some key senators believe the issue is already settled, banking associations are demanding that lawmakers close this loophole and protect the financial system. This isn't just about crypto versus banks. It's a high-stakes conflict over trillions of dollars, pitting legacy financial institutions against the new world of digital assets. The outcome will redefine the competition for consumer funds and the future of lending in the American economy. Believe it or not, this isn't just happening in a vacuum. While the US is debating how to regulate dollar-backed stablecoins, China is moving full steam ahead with its own central bank digital currency, the ECNY. China is actively expanding the ECNY's network for cross-border payments, especially with partners in Southeast Asia and the Middle East. Some reports suggest this could eventually allow a significant portion of global trade to bypass the US dollar-dominated SWIFT system. So the longer the US takes to create a clear framework for its own digital dollar ecosystem, the more ground it could lose in setting the future standards for global digital finance. This could ultimately challenge the US dollar's long-standing role in global trade. So, what should we watch for next? Keep an eye on the progress of stablecoin legislation in Congress. Also, watch the weekly deposit data from the Federal Reserve. If we start to see a consistent outflow from smaller and regional banks, that would be a leading indicator of stress in the banking system. This could have knock-on effects, potentially leading to tighter credit, which could impact everything from housing loans to business investment.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.